Okay. Okay, we're on.
Mr. Chairman, I've been reminded that I had not yet moved for the admission of what I believe are Exhibits 54 and 55.
53 and 54. Okay, any objection?
Mr. Chairman, Mr. Havert had some reservations that he described about those exhibits, that he wasn't familiar with them. He also mentioned that he had provided the same information in a response to the ORS AIR 3-18. What we would propose to do is allow those to come in to evidence, 53 and 54, and also offer this. And I've got a copy. I don't know how we made a copy of it while we were in the hearing room, but I have a copy I'd like to offer. In the event that there's a discrepancy, we would have the response that Mr. Havert had actually prepared, so that we can, if there's a correction, we can refer to our exhibit.
Okay, that's fine. We'll do that as 55. And we'll enter the exhibits 53 and 54 will be entered into the record, and this exhibit will be entered as Exhibit 55.
Thank you, Mr.
Okay.
Chairman.
Good. Commissioner Williams.
Thank you, Mr. Chairman. I would like to take a point of personal privilege and introduce one of my mentees, a young man by the name of Henry Peterson. He's a sophomore. Stand up, Henry. He's a sophomore at Benedict College here in Columbia. He grew up in Wagner, South Carolina, which is my hometown, and Commissioner Belzer's district within that district, and currently lives in District 6. Henry says that he's interested in the practice of law and would like to see what we do here at the Commission. So thank you, Council, for putting on a pretty good show for Mr. Peterson. Hopefully he decides to pursue a profession in the law. Thank you, Mr. Chairman.
Thank you, Commissioner Williams. Mr. Nelson.
Yes, sir.
ORS.
Mr. Havert, Mr. Sullivan, good morning. I think we're still in the morning. I'm going to try and get done here in the morning, too, so we'll go as quickly as I can. And these are kind of more simple questions, I hope, that we can get through. Mr. Havert, I'm going to start with you. Can you tell us what Duke Carolina's currently approved ROE in South Carolina is? Do you know that?
10.2%.
Do you recall what your recommendation was to the Commission in that last rate case in 2014?
I believe it was 11.25%.
And I would agree with that, yes, sir. Based on your own analysis, your recommended ROE has dropped by 50 basis points, 0.5%, correct?
Yes, my recommendation is now 10.75.
I'm going to have you check me on some basic math now. If you take that 10.2 that we had that was awarded by this commission in 2014 and you subtract 50 basis points, you end up at 9.7%. Is that correct?
You do, but again, this goes back to a point from earlier this morning. I think that type of extrapolation is just not how investors would look at the markets, would look at required returns right now. But your math is correct. I just disagree with the premise.
Yes, sir. Do you know what Duke's authorized ROE is in its other jurisdictions? By that I mean North Carolina, Ohio, I guess Florida, Kentucky, Indiana. Do you know any of those?
Well, I know 9.9 in North Carolina, and it pretty much ends there for me.
Okay. Do you know what the company is currently earning in South Carolina?
Not as I sit here right now.
Okay. Mr. Sullivan, do you by any chance know what the company is currently earning, the return?
I do not.
Okay. The company, with the award of the 10.2 ROE, the company still continues to pay dividends, the parent corporation, correct?
Correct.
Okay. And in fact, could you tell me do you know what the per share dividend has been over the last year per quarter?
It's currently at 0.9275 per share.
Okay. So
per quarter.
So would you say that the company is on sound financial footing?
The company historically, over the past several years, has been able to achieve a consistent dividend payment. So if your question is using the ability to pay a dividend to a utility shareholder, a proxy for, I think there are multiple proxies for sound financial footing, but we have demonstrated an ability to pay a consistent quarterly dividend.
Thank you, sir. Mr. Havert, going back to you, what has the company done, or how can you explain how the economy has changed over the past 5 years to warrant an increase to a 10.75% ROE?
I thought you said we'd be done by noon. A lot has changed over the past 5 years. I think if we look at the most obvious indicator of change, if we look at the intervention of the Federal Reserve in the capital markets, that has greatly affected how investors perceive returns, how investors perceive risks. The market has really fundamentally changed. You mentioned a minute ago that the recommended return has fallen. And in part, that's just the consequence of the fact that the Federal Reserve now has $3.8 trillion of assets on its balance sheet that it put on its balance sheet with the intended effect of lowering long-term interest rates. In large measure, that accounts for the reduction that I have in place. To me, the question becomes, can we assume that that level of intervention and its effects on the capital markets will remain in place forever, in perpetuity, going forward? And I don't think we can. So I think as we look at the markets, as we look at how the Federal Reserve eventually normalizes its policy, eventually unwinds its balance sheet, we're going to see changes in the capital market, and we'll see a market different than it is now. So I do think we have to take all those things into account.
Do you think that Duke is, for any reason, the Duke Carolinas is a riskier company or on more dangerous financial footing than it was in 2014?
I think if we look at basic indicia such as credit ratings, probably no.
Isn't the 10.75 something that investors would expect from a high-risk company, a return of that measure?
No, I disagree. If we look at if you look at risk, and let's put aside the question of credit ratings, if you look at the principal measure, the most visible measure of equity risk, the beta coefficients, it's lower than the market. But I think the return that I calculate, even taking into account the relative risk of utilities to the overall market, it is a reasonable number. Keep in mind that over the past few years, the return on the overall market's been between 14 and 15%, historically about 12%, with a 19% standard deviation. It's quite wide. I think if we look both historically, over the long term, over the near term, the 10.75 is reasonable.
Utility stock in general is pretty safe investment. Isn't generally viewed as that, especially a large electric utility like Duke?
Well, I guess that depends on who you ask and what the company is. There certainly are circumstances where utilities have run into circumstances that have been difficult for their investors. But if your question goes back to the point we just made, are utilities generally considered to be less risky than the overall market? I think we all would agree with that.
So going to specific utilities, somebody like Georgia Power right now you'd view as a greater risk, wouldn't you?
I'm sorry, can you explain that to me?
Sure. Based on the nuclear plants that Georgia Power is currently attempting to build, isn't an investment in Georgia Power a riskier one than in a company like Duke?
Well, I think for Georgia Power, would an investor look at the capital spend? It would. Would an investor look at things that Mr. Parcell thinks important, credit ratings? It would. And from that perspective, Georgia Power's rated, I'd say, fairly close to Duke Energy Carolinas, but is a large capital expenditure program important to investors? I agree that the need to access capital is important to investors, and I think that goes to a point Mr. Sullivan made a little bit earlier, which is the need to maintain the financial profile so that you can access capital markets. And one last point, that ability to access the capital markets isn't necessarily set just for when times are good. It's for when times are tough. It's for those market contraction periods. Not even 2008, 2009. There are times when the markets can contract for less obvious reasons. But because utilities must access the capital markets, they don't have the option not to. maintaining that strong financial profile is very important to them.
So, is it your position that Duke would not be able to access these capital markets if they were only making authorized a 9.7 ROE?
I think it's a very good question. I think what would happen is if the financial community saw a 50 basis point reduction in the company's return here in South Carolina, and if the financial community considers the predictability, the stability, the consistency of regulatory treatment to be important, and we know it does. We understand that Moody's puts 50% weight on the regulatory environment as it determines ratings. I think a reduction of 50 basis points like that would be of considerable concern to the financial community.
All right. Let me move on and ask, are there other factors that should be considered in awarding an ROE, in a commission awarding an ROE, other than the analysis that you use, other than return specialist analysis?
If your question goes to the balancing of interests, then yes, of course, commissions always have to balance the interests of investors and ratepayers. One of the things we always have to keep in mind is that, at least in my view, you cannot disassociate the public interest from just and reasonable rates, and you cannot disassociate ratepayers' interests in a financially strong and a financially stable utility. So yes, commissions must balance the interests of investors and ratepayers, but the ratepayer interest also goes to the financial strength of the utility.
Would you agree with me that it's incumbent on commissions to consider what effect a high ROE would have on customers' ability to pay rates of the company?
That is a consideration for the commission, and I am always reluctant to presume to tell the commission what I think it should do. My role is to advise the commission as to what I think investors require for their returns. That's what I've done here. I've given the commission my view of the required return. It's up to the commission at this point to take that information and come to a conclusion as to what it considers to be a just and reasonable rate. But again, I would go back to the point that I do not think we can disassociate just and reasonable rates from the public interest in a financially strong utility.
Thank you, Mr. Havert. Mr. Sullivan, I'm going to ask you, could you turn to page 4 of your rebuttal testimony for me?
I'm there.
Thank you. Can I ask you please to read the last sentence on that page beginning with the word approval?
Approval of this request will allow the company to maintain its healthy credit profile, generate adequate cash flow to support its critical capital investments, and fairly balance the needs of affordable electric rates for customers and an acceptable ROE for equity investors.
Thank you, sir. Could you tell me how do you or how does the company weigh the affordability of rates in this balancing test you're talking about there?
Well, I think one of the ways we tried to deal with that was by mitigating customer rate impact by coming off of our expert ROE witnesses recommended 10.75% to a 10.5%.
So the basis you start with would be Mr. Havert's recommendations, and then you believe that just the 0.25 or 25 basis point reduction is sufficient to make it affordable?
I'd say that would be one component, and then a variety of other experts or subject matter experts within the Duke Energy and outside witnesses would have collaborated in arriving at what we think is a fair balance. The area of expertise that I can communicate is primarily focused on the other side of the balancing act, which is investor expectation, both creditors and equity investors.
Can you tell me, do you have an idea how Duke's healthy credit profile would be affected if a large number of customers can't afford to pay their bills? Your uncollectibles go up significantly, in other words.
that would have I think the credit quality or the predictability of cash flows would be challenged in that scenario.
Thank you. No further questions. Thank you, gentlemen.
Thank you. Commissioners. Commissioner Whitfield.
Thank you, Mr. Chairman. Good morning, Mr. Sullivan, Mr. Havert. Mr. Havert, Mr. O'Donnell yesterday, witness for the South Carolina Energy Users Committee, made the statement that kind of going to characterize or summarize his statement, something to the effect that the days of double-digit ROEs are gone or history. Could you respond to that?
Yes, I'm not sure of the basis of Mr. O'Donnell's conclusion. I know he did not provide a recommendation in this case, so I'm not sure on what basis he concluded that. In my view, the return that I see investors require is going to be forward-looking. It's going to consider the risks, and it's going to consider the prospects on a forward-looking basis. If Mr. O'Donnell is looking backwards, perhaps there were years when the returns had fallen. They're no longer falling. That's one thing. But second, as we look forward, as you must do when estimating the cost of equity, I think we see volatility. I think we see capital market risks. I think we see the need to finance infrastructure that, in my view, certainly justifies a double-digit rate. So I'm not quite sure the basis of Mr. O'Donnell's position, but I think on a forward-looking basis, I would disagree with him.
Let's shift to another question just quickly. You say in your testimony that FERC, along with state commissions, have noted the tendency of the DCF model to produce unreliably low results and the importance of looking to other methods to determine cost of equity. Could you briefly expand on that comment just a little bit? And I know it's in your testimony, but if you could briefly summarize your reason for that.
Yes.
Saying that.
I'm sorry, sir. Yes, I think if we look at certain orders from the North Carolina Commission, from Maryland, others, commissions have understood that the discounted cash flow model, simply by virtue of its construction, is now producing fairly low results. And I think it's doing so because in the past, in the recent past, as the Federal Reserve put a lot of capital into the capital markets and pushed down yields, you saw from time to time investors would go looking for yield-producing investments. And that would have the effect of pushing down the dividend yield on some of those stocks. The problem from the perspective of the constant growth discounted cash flow models is it assumes those conditions will stay in place forever. It assumes that whatever conditions produced a relatively low dividend yield will not change, and the dividend yield will stay at that level. So just for the purpose of discussion, let's say the average dividend yield is somewhere around 3.5%. If interest rates 10 years from now are at 5%, the model does not take that into account at all. That's, I think, part of what utility commissions are seeing, and they're just seeing results in the low 9% range, in the 8% range, that on its face are far removed from the results of other methods, far removed from returns that are being authorized in other jurisdictions, and are unlikely to support the company's financial condition. That's why I think as recently as last week we saw the FERC open a notice of inquiry to look at 4 methods and how those methods would be implemented.
Thank you for that answer. Now that you mentioned the North Carolina case, in the company's North Carolina rate case last year, a settlement agreement was reached providing a 9.9 ROE, which is, of course, less than your range of 10.25 to 11% that you recommended in that proceeding. Could you provide some insight as to why the company accepted a lower rate of return than the range you specified in your testimony?
I'm reluctant to speak for the company, but I can tell you what I generally believe I said in testimony supporting the stipulation. And that would be that we have to look at the stipulation taken as a whole. And it was the company's judgment that taken as a whole, the stipulation enabled it to access the capital markets to maintain its financial integrity. But I think that looking at the entirety of the stipulation from the company's perspective was the important perspective. And if we were to pull one item out of the stipulation, I'm not sure we could always come to the same conclusion. But my testimony, I believe in that case, would have been in support of the stipulation that taken as a whole, the settlement agreement, the stipulation, would enable the company to maintain its financial profile.
Thank you, Mr. Havert. And Mr. Sullivan, I believe I'm going to leave you out this time. Thank you, Mr. Chairman.
Thank you. Commissioner Belzer.
Thank you, Mr. Chairman. Good morning, Mr. Sullivan.
Good morning.
I just had a couple of little points I wanted information on. On page 4 of your rebuttal testimony,
Yes.
In lines 2 through 4, you mentioned that in 2018 the company entered into a $52 million 20-year capital lease. What was that for?
I believe that was an equipment lease.
I was just curious on that. And then I think you answered my other one. Thank you. Mr. Havert, how are you this morning?
I'm well. How are you?
Fine, thank you. Just a couple of observations during your testimony. You used the phrase a couple of times, constructive regulatory environment.
Yes.
What do you mean by that?
When I use that phrase, I use it from the perspective of the financial community. And the first place you can look to the importance of a constructive regulatory environment would be from rating agencies. So from a constructive regulatory environment, from their perspective, it means enabling the company to maintain a financial profile that will allow it to access capital markets efficiently. And when I say efficiently, I mean they can go into the capital markets when they need to, and they can do so at reasonable terms and at reasonable rates. We saw back in 2008, 2009, there were great differences in the yields that companies achieved when they tried to issue debt based on differences in credit quality. And even within a given credit rating, there would be differences because investors would look to the individual company. So the supportiveness, the constructiveness of a regulatory jurisdiction goes to the ability to maintain the credit profile, which enables the utilities to access markets. And one last point on that is utilities, again, are capital intensive. They just invest in a lot of long-lived assets. And in that sense, they're different than unregulated companies. The assets that they invest in, utilities, tend to be what we refer to as irreversible. You can't use it typically for another purpose. As a consequence, utilities do not have options available to them that unregulated companies may, in terms of deferring investments, in terms of deferring the need to access capital. So maintaining that strong financial profile is very important from the investor's perspective.
I also jotted down lowest rated jurisdiction as a phrase.
Yes.
Can you tell me what you mean by that?
It goes to the same issue. Organizations such as Regulatory Research Associates, which we talked about a bit this morning, rank the supportiveness of jurisdictions from more supportive from an investor's perspective to less supportive. So those jurisdictions that are considered less supportive are viewed by the financial community as such. And when you look at, again, from the rating agency's perspective, the importance of the regulatory environment, a low ranking, the perspective that a jurisdiction might not be as supportive of utilities is a risk to investors.
Is that based solely on the rate of the return on equity that is granted, or are there other factors that go into that?
That's a great question. It's my understanding is it's based on a host of factors. It's the return is one, the ability to earn that return is another. There may be jurisdictions where you'd have a return that's authorized, but because of restrictions put on the company, the ability to recover cost in a timely manner, the ability to earn that return may be significantly lower than other jurisdictions. So that would be the type of factor also considered.
Is it based only on the utility commissions or PSC's actions, or does it also encompass legislative actions?
It could be legislative actions as well. To the extent that there is legislation that affects how regulatory policy is implemented, it could be legislative as well.
Does it also look at the dynamics of the customer base, where you may have challenges facing a large segment of the population that make it hard for them to pay increased rates versus areas where it may be more socioeconomically on a higher level? Sorry, thank you.
That is a good question. The answer is I don't know. I'm not sure how regulatory research associates would consider. I'm not sure how they would consider or reflect that circumstance.
I reckon my question is, does it go to the ability of the customer base to pay their bills? Does that impact it somehow?
I think I'm not sure that is a direct input, but I will say that regulatory research associates is very familiar with policy-related issues, and I think takes into account always, as we were talking about a little bit earlier, the understood necessity of balancing ratepayer and investor interests.
I also had some questions about regulatory research associates. What kind of organization is that?
It is now a part of, and it has changed over the years, but is now a part of S&P Global Market Intelligence. So it's an organization that originally was out of the lovely town of Jersey City, New Jersey. And I say that because that's about where I'm from. But
I think you're from Delaware, is that, or you went to school in?
I went to school in Delaware. It's a bright line. It's a fine distinction, but an important one.
I understand that.
People from Delaware will tell you that. And so it's an organization that has spent years reviewing the regulatory environment and in particular reviewing orders and decisions that come out of jurisdictions.
Is it independently funded? Is it funded by utilities? Is it funded by, do you have any idea?
It's privately held. So it's part of Standard & Poor's, basically.
And so utilities, analysts, everybody can subscribe. Anybody can subscribe to their work. Is that correct?
It's not cheap, but yes,
you can. I understand that. Nothing is these days.
Yeah.
The other term that I had was credit supportiveness.
Yes.
And then the context of, I think it was commissions being in a position for credit supportiveness. What does that mean?
That goes back to a couple of the points we were just discussing. It means ensuring that the utility maintains a strong credit profile, a strong credit rating. And credit supportiveness typically is viewed from the perspective of debt investors, fixed income investors, because to them the concern is receiving payment on the debt their interest, their principal payments on time and in full. So the credit rating is an opinion as to the company's ability to do that. Because the utilities must raise both debt and equity capital, the ability to meet their financial obligations is very important. So credit supportiveness is the extent to which regulatory policy supports that credit profile.
What would happen if an ROE was set too high? Is there such a thing? Or is it just give me the biggest thing you can give me?
No, there is such a thing. And I think that, well, let me step back a little bit. Before I went into the consulting business, I spent a lot of years at a utility and was part of the rate case planning process. And I can assure you that every time we considered whether to seek rate relief, those are the questions we would ask ourselves. How much do we need this rate increase? What would the rate effect be? So I think from my perspective, the answer is no, the highest possible return's not always the right return. I know that utilities, again, utility commissions have the obligation, the very difficult task of balancing those interests. And I think more importantly, investors know that.
You also mentioned that large capital expenditure programs are important to investors.
I would say large capital programs are important to ratepayers for the provision of utility service. And the large capital programs, because they represent both financing risk, execution risk, operating risk, is a source of risk to investors.
Is it also a source of expected return?
As you add rate base, yes, of course, the company's returns will grow. And from an investor's perspective, that's part of the growth that they look to. And so if you're an investor and you see two companies of about average risk, one with higher growth prospects, you then have to weigh, where will you allocate your capital to those two companies? So
if a utility announces, say, a multi-billion-dollar investment in, I don't know, grid modernization, perhaps?
Perhaps.
That's going to be important to people investing in stock?
Yes, I think if we look to what investors will think about, then yes, they will look at that. Now, again, what's important is that from an investor's perspective, there are both growth prospects and risks associated with it. So it's always the balancing of the two.
Thank you very much. Appreciate your attention to my question.
Thank you.
Commissioners. Commissioner Irvin.
Thank you, Mr. Chairman. Mr. Sullivan, as treasurer of Duke Energy, what is the revenue request in this case?
Thank you, Commissioner. I'm the assistant treasurer of Duke Energy Carolinas. One can only dream.
I just gave you promotion. Congratulations.
Can you repeat the question?
Yes, sir. It's unclear to me where we are in terms of this case. What is your revenue request?
The revenue request is, I don't have the exact dollar figure. I've been focusing more on the request of an ROE and the cost of debt.
Could I guess everyone is interested, all the stakeholders are interested when they look at a rate case of what percentage of increase. So I'm not necessarily interested in the dollar amount, but the increase in revenue being requested. Is that something you could tell us?
Yes, it's in the neighborhood of 10%.
Okay. And someone mentioned the North Carolina case. What did that case ultimately give Duke Energy Carolinas in terms of the rate of increase?
Yeah, that I don't have the exact figure. I know that there were numerous adjustments to that case throughout the case.
Right.
Tax reform having a pretty meaningful variation to that number as the case progressed.
And there may be more adjustments to come. Is that right? There's some unresolved issues or not? I'm not sure.
Perhaps. Well, there were some issues that were to be decided in a future rate case.
Right. Is it in the ballpark though of 9 to 10%? Is that kind of what you're?
Again, I think with each rate case, one could look at the increase in revenue requirements on a percentage basis. What we always intend to do is to try to look at it on a more annualized basis from the last rate case. In this example, I believe while the 10% area is a number we spoke of earlier, on a more annualized growth rate of revenue, it's we're trying to track at or around inflation for affordability purposes.
So would you look at the test year for 2017 to gauge the rate of inflation, or tell me how you'd figure that, if you know?
I think we'd look over probably a longer term period than just specifically pointing to one moment in time,
right,
given a multi-year period between rate cases.
Well,
and I think
2 to 3%, would that be a fair rate of inflation for that period?
Perhaps. I'm not an economist,
sure,
so I can't say for sure.
Thank you, sir. But in any event, the stipulation of 9.9 ROE in North Carolina, the company deemed fair and reasonable. Is that fair to say?
As part of a broader settlement agreement, that is the case.
And I read somewhere where about 57% of all rate cases are settled. That surprised me a little bit. Only 43% are fully litigated. I don't want to get into specific settlement negotiations, but are you making an ongoing effort to try to resolve this case, short of a full litigation and a final order, or do you know?
The primary focus of my testimony has been on the capital structure and the cost of debt for this case.
Thanks, sir. I'm going to turn my attention to the expert now. Mr. Ebert, we heard earlier that the national average for return on equity is 9.32%. Would you agree with that?
9.32?
Yes, sir.
No, I don't think I would agree with that for a company like this. I'm not entirely sure how that number would have been calculated.
Yes, sir. I had a note. It might have been, I'll have to go back into my notes to see if I could identify which witness told us that. But you would agree that the recent action by the Federal Reserve seems to be putting the brakes on rate increases. In fact, they've indicated there'll be no more rate increases for this year and perhaps maybe only one for 2020. Is that your understanding?
Right, and when we talk about the rate increases from the Federal Reserve, that's the overnight rate, the very short-term rate, and of course utilities are most sensitive to long-term rates.
But they do have an effect on long-term rates, don't they?
They can. I think part of the complication of the Federal Reserve policy over the past few years has been the combination of, as you say, first decreasing, then increasing the overnight borrowing rate, and then secondly, the addition of the $4 trillion to the balance sheet. It's the latter, the addition to the balance sheet, that put pressure on the long-term rates. So there would be generally an effect on the short-term end of the curve. How it translates to the longer end of the curve, I think, has become very complicated by the way monetary policy has been implemented.
Is that what you call an inverted yield curve?
That's a really good question. I think that for the portion of the yield curve that's important to utility investors, the long end of the yield curve, it's actually fairly steep right now. So the difference between the 30-year and the 10-year yield is positive and greater than it had been over a little bit. Now, there are portions of the yield curves, say between the 7-year yield and the 2-year yield, that are inverted such that right now the 7-year yield is lower than the 2-year yield.
And that helps utilities in a certain degree, doesn't it?
Well,
can't they go back in and refinance certain debt?
They could, but I think, and Mr. Sullivan may have a view on this as well, but in my experience, what utilities like to do, what I used to do when I managed the treasury function of a utility, was to try to match the life of the securities with the life of the assets. So you would try to extend the maturity of debt as long as possible. So in my experience, there are few times that I would look to place debt in the 5 to 7 year range. I would generally want to extend the maturity longer than that.
Thank you, sir. That's all the questions I have.
Thank you.
Commissioner Williams.
Thank you, Mr. Chairman. My first question is for Mr. Sullivan. How does the company balance the need of the company to maintain strong credit metrics with the ratepayer demand to maintain lower rates?
Thank you, Commissioner. I'll take the first part. Our ability to maintain strong credit quality is part and parcel to providing affordable rates to customers. We're in a good position with our current credit ratings. We like the credit rating that we currently have for Duke Energy Carolinas. It is actually among one of the higher rated utilities within our portfolio of utilities. And there is a very good reason for that. It is also one of our largest, and with that size and that commitment to a broader population of customers comes the necessity for good credit quality to access capital markets in the most efficient way to keep rates low. So I'd say it's somewhat circular that maintaining strong credit quality gives us the ability to capitalize the utility in a way that ultimately is part of the equation of keeping rates low.
Switching to Mr. Hebert, you've testified a lot in hearings like this one, right?
I'm hearing that a lot today, but yes, I have.
Do you recall if a utility commission, has ever adopted your recommended ROE?
Yes.
Okay. Could you give me an example? Because I'm referencing exhibits 54 and 53, and I don't see a case here in those two exhibits. I know that the range was adopted, I think, twice, but in terms of your recommended ROE, has there ever been a commission to adopt your recommended ROE?
Well, I think most recently, this commission looked to my recommendation for SC, E, and G and found it to be reasonable. As to a specific recommendation, I'm going back to thinking about the Florida Power and Light case. I believe the 10.55% return was part of my eventual recommendation, but I'd have to go back and look at that. There are orders that I can think of offhand where the commission has gone through and agreed with my approach, agreed with my conclusions, but because commissions consider a variety of issues, in that case, this was in Missouri, set the return within my range, but not at my specific point estimate.
So the answer to my question is no. There hasn't been a commission that has adopted your recommended ROE.
this specific point estimate, as I sit here, I cannot think of one. Again, I don't mean to try to get around the issue, but I do think it's important to keep in mind that a recommendation includes a range, and many times the Commission authorized return within the range. But as to your specific question, as I sit here, I cannot think of one. But I also don't think that that's unusual because these issues are often so widely litigated. There are a lot of recommendations in any given case. I think it's unusual for a commission to choose one specific witness's recommendation rather they consider all the evidence.
How do you explain, just referencing again Exhibits 53 and 54, how do you explain what I would consider the significant difference in the Commission's adopted ROE and your proposed ranges?
Well, I think first off, if you look at the ranges, the differences are not always significant. Sometimes my recommended range includes the final return. Sometimes it's a handful of basis points away. I think if you were, again, to look in these jurisdictions, we have to consider the extent to which they're considered supportive or not by the financial community. So there's a variety of issues we have to look at. But in the end, my recommendation is my recommendation, and I always stand by it. I think it's the correct number. And I give the bases of my analyses to the commissions for their consideration. What the commission does in terms of weighing that evidence, in terms of weighing ratepayer effects, is, of course, the commission's obligation. But the other point I would make is that I think if you were to pull together this type of information for many witnesses, I'm not sure that this stands out all that much.
South Carolina Energy Users Committee offered a witness, Witness O'Donnell. He provided testimony regarding rate of return. And he actually testified yesterday that a 9% return on equity would be appropriate in this case. What are your thoughts and opinions about a 9% rate of return or return on equity? Excuse me.
Sure. Well, first off, again, I have no idea how Mr. O'Donnell came to that conclusion, what analyses he did or did not do. But on its face, it's extraordinarily low. If you look at the returns that are being authorized in other jurisdictions, even for the lower rated jurisdictions, 9% is below that. The question becomes, to me, twofold, and it's twofold putting aside methodological issues, because I don't know how Mr. O'Donnell would have arrived at that number. But if we look at the fact that the company needs to compete for capital with other jurisdictions, it makes it difficult for a company in a jurisdiction authorizing 9% to compete with companies operating in jurisdictions that offer considerably higher returns. That's one thing, just the competition for capital. The second is, I'm not sure how Mr. O'Donnell would have come to the conclusion that 9% would enable the company to maintain its financial integrity. If you consider the Hope and Bluefield comparable risk, financial integrity, capital attraction standards, I don't know how he would come to the conclusion that 9% would satisfy those standards.
I want you to educate me a little bit about competition amongst investors or competition that utility companies face to attract investors, better put. Is it your opinion that a utility with a rate or return of equity of 9% would struggle to attract investors?
I think it would struggle to attract investors relative to a utility that was able to offer a higher return, that was able to see the prospect of being able to earn that higher return. So I do think that the competition for capital is significant. I think that we have to always keep in mind that financial integrity matters most when the capital markets become constrained, when the competition becomes most acute. That's when we really have to be concerned with the ability to attract capital. So, yes, I do think that those types of differences are meaningful. And it's meaningful not only from the perspective of the ability to generate income and cash flow, it's meaningful from the perspective of the signal it gives, again, regarding the credit supportiveness, the stability, the predictability of a regulatory environment. I don't know if Mr. Sullivan may have thoughts on that as well, but that would be my view.
You're welcome to chime in, Mr. Sullivan.
Oh, sure. I'd be happy to. Thank you. And in response to your question, how would the investment community react to a 9% ROE? I could assure you that it would send a very negative signal to our investors. Part of my job is to serve as a liaison between Duke Energy, both the utilities and the corp, with primarily debt investors, but also from time to time equity investors, and most importantly in my role, the credit rating agencies. I can assure you that each of those stakeholders is acutely watching this rate case and is interested in the outcome of this rate case. We have had numerous conversations with many of those constituents in the weeks leading up to this hearing. And a departure from 10.2% where we sit today, 120 basis points down to 9% or anywhere meaningfully departed from the 10.2%, let alone the 10.5% that we have requested, would be, I think it would be seen as a strong departure in what investors and credit ratings would have expected from this case.
Okay, and I appreciate you sharing that with me. And I don't know if you two know this or not, but the Commission has strongly advertised the fact that this proceeding is live streamed. We went to a number of night hearings, and the witnesses there expressed their interest, strong interest, just like your investors. The ratepayers are closely watching this proceeding. And so I would like to go through a fact pattern with you. Let's just say, hypothetically, that this commission approved or adopted a return on equity of 9%. What would happen next?
I would say the first likely reaction, and again, I can only give you what I think may occur. Obviously, I don't have any control of what investors or credit rating agencies would do, but I think my personal view as to what may occur is that probably beginning with the friends at Moody's and S&P that monitor the creditworthiness of Duke Energy Carolinas, they would likely provide a written report as to their view on Duke Energy Carolina's ability to earn a predictable stream of cash flow from the South Carolina portion of that utility. And I emphasize the word predictable. Stability of cash flows for a utility is of extreme importance because the payment of an expected quarterly dividend is sacrosanct to our value proposition to attracting capital. So I think the knee-gut reaction from the investment community would be, I no longer have the clarity or anywhere near a good expectation of what to expect each time Duke Energy goes into a rate case seeking recovery on prudently incurred costs. For example, the 120 basis points departure between where we currently are today and the hypothetical example you described, I think would fall in the category of introducing a significant amount of variability and unpredictability of cash flow.
I appreciate that. Well, let me ask you this. Would it not also provide an opportunity for the company to self-evaluate and say, are there anything we can do differently to improve maybe our customer service or improve how we're spending our money? A number of improvements that could particularly change the way the company is perceived. Would it force any internal changes?
It's a good question. What I do know for sure is that all of the capital that we are seeking to earn a fair recovery on is based on what we believe has all been deployed to do exactly what you're describing, to improve the customer experience, to provide safer, more reliable, and increasingly cleaner energy. So it wouldn't change any of the investments that we have made historically. Those are in the rearview mirror. With respect to how we conduct ourselves going forward, again, we have an obligation to serve, and I don't think it would in any way impact what we believe are prudent investments to enhance the customer experience and deliver on all the things I just cited. But one thing for sure would happen is the cash flows needed to finance the capital that we borrow from both lenders and investors would be significantly lower, and as a consequence of that, our lenders and investors may be challenged in being attracted to investing in the company for the investments that we believe are going to be prudently incurred and would be bringing forth for you to be the judge of that.
And this is my last question, and I don't know if you will be able to provide any commentary on this or not. But we've heard testimony about an event called the Lineman's Rodeo, and we've heard testimony about coffee being provided to employees. Under our little fact pattern hypothetical, do you think the coffee and the Lineman's Rodeo will still make the budget if a 9% return on equity was adopted by this commission?
I wish I could address your question, Chairman. That's not something I feel qualified to address.
All right, thank you very much.
Commissioner Hamilton.
Mr. Chairman, thank you. Mr. Sullivan, just one short question for you. What results have you experienced from credit bureaus as a result of the North Carolina case that was 85 basic points, I believe, reduction? 10.75 to 9.9.
Thank you, Commissioner. As a result of the 2 North Carolina rate cases that were ordered last year, there were numerous write-ups from the rating agencies. I think that on one side of the equation, they gave a nod to North Carolina Commission for certain credit quality, sort of a nod to the credit quality and a nod to the credit community in allowing Duke Energy Carolinas in North Carolina to recover prudently incurred costs. 2 primary focus points of both of those cases were tax reform and resolution of how coal ash remediation is to be recovered. And so they specifically pointed to constructive recovery of those prudently incurred costs. Now, at the same token, they did go on to say, however, Duke Energy Carolinas has increased pressure on its credit metrics for its given credit rating. They often look to the cash flow of a company and its ability to service the debt. Duke Energy Carolinas has approximately $11 billion of debt as we have continued to grow, and in accordance with the regulatory approved capital structure. And so by reducing the ROE, it introduced lower cash flow on the rate base assets to service that debt, and pointed out that there has been a trend, and this trend will continue, on pressured credit metrics for its current rating. They then go on to say, however, the regulatory supportiveness from these rate cases partially offset the observation that the credit metrics have experienced deterioration. So I think, in summary, it was sort of a balancing act that they saw between weaker credit metrics as a result of a lower ROE, offset by a demonstration by that commission of credit supportiveness.
Thank you very much.
Thank you.
Thank you, Mr. Chairman.
Thank you. Any other commissioner questions? Mr. Sullivan, just one quick one I don't think has been asked. On page 13, I know I'm hiding behind Ms. Tackett here.
This way.
You're okay, Ms. Tackett.
13 of my...
On page 13 of your direct testimony, it just says that in the company's North Carolina rate cases, Duke Energy Carolinas was allowed to delay the give back of protected and unprotected excess deferred income taxes until the earlier of 3 years or the next base rate case. Are there benefits, or can you quantify any benefits to the company that you would get from delaying payback of overcollected revenue?
Yes, I'd say the primary benefit is not immediately flushing all consequences of tax reform out of the system, cash flow out of the system all at once. Immediately, we began recalculating the rate collection as a result of the lower corporate income tax rate. So that was an immediate reduction of cash flow. And there were other parts of tax reform that went into effect immediately. But one, to Commissioner Hamilton's question and my response to that, I could have gone on to elaborate that part of the regulatory constructiveness of that case was sort of a sharing of some immediate flow back to the customers on the customer's entitled benefit of tax reform, but not all at once, and holding some of that back to maintain better credit quality than had all of it gone out at once. And so I think the 3-year deferral there was sort of a nod to not make the impact quite as draconian as it otherwise would have been.
Okay, so everybody benefits a little bit, company and the ratepayers. And okay. Commissioners, any other questions? Any redirect?
Mr. Havert, in answering questions from Ms. Grumman, you made a distinction between distribution-only companies and ROEs versus vertically integrated companies.
Yes.
Would you explain the significance of that distinction?
The difference is that a vertically integrated company owns and operates generating facilities, whereas a distribution-only company does not. These are companies that in the late 1990s, early 2000s, divested their electric generation, so they simply distribute electricity, either electricity that's bought from customers from a third party or that the companies buy but do not generate. So they do not have the need to finance and operate large generating plants.
Would you typically see a higher ROE in the vertically integrated companies?
You typically do. We have seen cases recently in Massachusetts, for example, which is a distribution state where the ROE was 10%. But generally speaking, yes, I think you're right.
Mr. Sullivan, Ms. Grunman also asked you a question I'd like to follow up on about this, your chart that was in your rebuttal testimony, and in particular, she asked you if the Georgia Power authorized ROE of 10.95% was entered in 2013, and I think she was suggesting that it should be disregarded. Do you recall that exchange with her?
I do.
Is Georgia Power a utility that Duke competes with for investors' money?
It's very similar in many respects to Duke Energy Carolinas.
Okay. And does it matter to investors what the year of the order granting a return on equity was entered?
I would not think so. I think they're primarily focused on what their existing investment will earn.
Mr. Havert, did you testify for SC&G in the proceeding that established a new return on equity for the company in 2018?
I did, yes.
Okay. And what was your recommendation to this commission?
It was 10.75%.
Okay. And do you recall, have you reviewed the commission's order that was, I think the original order was entered on December 21st of 2018, and then an order on reconsideration that was issued on February 12th, 2019?
Yes, I have.
Okay. And on the in the order on reconsideration, the Office of Regulatory Staff asked the commission to reconsider the 9.9 ROE that was entered, that the commission adopted as a result of a stipulation offered by the applicants in that case. Is that your understanding?
Yes, it is.
Okay. And I'm just, rather than to save time, I'm just going to read a couple of sentences from the commission's order. This would be order number 2019-122. Order states on page 27, the commission also rejects ORS's assertion that the 9.9% ROE on project costs rewards SCE&G for mismanagement. The actual market cost of SC&G equity is accurately estimated at 10.75%. The 9.9% return is substantially lower. Do you recall reading that, Mr. Havert?
I do.
Okay. Is that an example of a commission adopting your recommended ROE or your recommended cost of equity?
I think here the commission adopted the recommendation but recognized the stipulated 9.9%.
But the commission, in rejecting the ORS petition for reconsideration, the commission specifically said that the SC&G actual market cost of equity was accurately estimated at 10.5%, and that was your accurate estimate, wasn't it, Mr. Havert?
10.75, yes.
Yes, sir. And of course, one of the things that we've seen in the exhibits 53 and 54 is there is a distinction between settled cases and litigated cases. Do you typically see that when you look at ROEs awarded by various jurisdictions?
There can be, yes.
And why would that be?
Well, because I think as both Mr. Sullivan and I mentioned earlier, stipulation is typically viewed as a whole. So the terms of the stipulation typically are not viewed in isolation. Rather, it's the cumulative effect of the terms of the stipulation that matter. So a return may be different in a stipulated case than it would have been had it been fully litigated as a single discrete issue.
Thank you, sir. No further questions. Thank you.
Thank you. Any recross? Make sure you got that mic up.
Quick question. Do you recall that you have identified for purposes of your analysis a series of proxy group companies?
Yes.
Was Dominion the parent company of SCE&G part of your proxy group analysis?
No, by design, it wouldn't have been because of the pending transaction.
Thank you. No further questions.
Mr. Nelson.
Sure which one of you may be best able to answer this, but
It's Mr. Sullivan.
Mr. Sullivan, Mr. Ellerby was just up here talking about the latest ROE award, and actually, Mr. Everett, I think this more goes to you. Isn't it true that ROE that was awarded in that case or agreed to, isn't that just based on this? Isn't that just for the stranded nuclear costs?
It was based on the same types of analyses that I have performed in this case.
Right. But SC&G has authorized a different ROE as far as its general operations go, correct?
The general operations were not at issue in that case.
Thank you. Yes. Mr. Everett, one comment you made in answer to a question from Commissioner Williams, you seem to say that you said that access to capital markets is needed to keep rates low. Does that essentially mean that you need to charge customers more so that the rates remain low?
I think that's. Let me go back to what I think I would have said, which is that financial integrity is important for capital access and important to maintain a low cost of equity. One way of upsetting that balance is to depart from predictable regulatory treatment. So I'm not sure of your question entirely, but if the issue is it important to maintain a strong financial profile to ensure relatively low cost and efficient access to the capital markets, then yes, that's what I would have said. And I think if we look at the fact that the effect of a reduction in the rate of return has a proportionately large effect on net income and cash flow, then that is something that would be considered by the financial community.
Okay. I want to go to another statement, and I'm not sure exactly where this came in, but it was under Commissioner Williams' notes, and I'm having a hard time reading my notes sometimes. But was one of the statements that you made to Commissioner Williams, were you saying that if the commission doesn't accept your ROE range, that the commission is therefore not supportive?
I don't think I said that. I think what I would have said is that my role is to advise the commission as to what I think the cost of equity is, knowing that, like every commission, this commission has an interest and an obligation to balance the interests of ratepayers and investors. But I also said that balancing of interests necessarily considers maintaining a strong, healthy utility because ratepayers have an interest in a strong and healthy utility as well.
Okay. Thank you. Mr. Sullivan, you were asked a question by Commissioner Randall in reference to the Tax Cuts and Job Act, I believe. Don't you agree that ORS has in effect agreed with Duke on the impact of the Tax Cuts and Jobs Act? Are we in agreement on that position?
I'm not certain of all of the particulars of what you're referring to, so I can't opine as to whether or not Duke Energy and the ORS is in agreement.
Isn't the credit constructive position on tax incorporated in ORS's recommendations? Are you familiar with their recommendations?
I'm not as familiar with the tax portion of this rate case. What I was referring to was when the final order came out in last year's rate case, I could provide Commissioner Randall with some reaction from the investment community as to the perceived constructive regulatory framework as it related to the Tax Act.
Okay. Thank you, sir.
Thank you. Any other recross? Okay. Gentlemen, thank you for your testimony. They may be excused.
Thank you.
Thank you.
Not to belabor anything, but if we could have an attorney's very quick conference with Mr. Dong, I mean, we can adjourn, but we just need to speak with counsel quickly, if that's okay.
Well, I wasn't about to adjourn. I was getting ready to
I didn't
call
mean
next-
adjourn. I'm sorry.
Next witness.
I'm sorry. I didn't mean that. I apologize.
While we're on switching out witnesses here, Mr. Chairman, I do have a copy of the late filed exhibit number 49 that was requested, I believe, by Commissioner Belser the other day, pointing out again that there is information. We don't necessarily agree with the position, but I believe there's still information that has been designated confidential, and I don't know if Mr. Ellerby has a position on whether the company's waiving that.
We have agreed to withdraw the designation of confidential on this, which is the response to AIR 55-5. And I'd just like to make it clear that the exhibit that's being provided by the ORS includes their request and the company's response to that request.
Okay. Please do. What you need? You can say something if you want.
Mr. Ellaby, over here. I appreciate the withdrawal of the confidential designation. I mean, is the company okay with that? I was not asking y'all to. If it needs to be confidential, I don't have an issue with that.
No, it's fine. We considered that, and that was we understood. The commission has been great working with us on protecting things that are confidential, but this information is now older. This is a couple of years ago, so it's the concern about it is not as it was. So we have no problem with withdrawing.
All right. Thank you very much.
Okay. Is that everything? Let's call the next witness. We're on a little different schedule today, but we're gonna plow on for another few minutes, and then I'll explain the rest of the day before we quit. Punch that your mic on, and Ms. Hager, you punch your mic on too. That red, you got it. Speak closely so they'll pick you up on live stream.
Good afternoon, Mr. Chairman, members of the Commission. Len Anthony, representing Duke Energy Carolinas. Ms. Hager, are you ready?
I'm ready.
Will you please state your full name for the record?
My name is Janice Hager.
And
That's good, Ms. Hager. It sounds all right.
by whom are you employed?
I am employed by myself as Janice Hager Consulting.
And what did you do, very, very briefly describe, you have a long resume, what did you do before you were in your own business?
I retired from Duke Energy at the end of 2014. At that time, I was Vice President of Integrated Resource Planning and Analytics. I'd been with the company for 34 years. 10 years of that was in the rate department, the last 3 years of which I was vice president of rates and regulatory affairs for Duke Power Company before its merger with Synergy.
And you are testifying on behalf of DEC with regard to the cost of service study upon which rates are being designed and recommended.
That's correct.
Prior to your appearance here today, did you cause to be pre-filed 18 pages of direct testimony?
I did.
I believe you have two minor typos that you wish to correct for the record on your direct testimony.
No on my rebuttal.
I was wrong. Okay, sorry. Do you have any changes to your direct testimony?
I do not.
If I were to ask you the same questions now that appear in your testimony, would your answers be the same?
They would.
Mr. Chairman, we ask that Mrs. Hager's direct testimony be copied into the record as if read.
Ms. Hager's pre-filed direct testimony will be entered into the record as though given orally from the stand.
All right, and did you cause to be pre-filed 17 pages of rebuttal testimony?
I did.
You have two minor changes to that testimony you'd like to give the Commission.
I do. On page 11, line 9 of my rebuttal testimony, I have a quote there without a citation. That citation should be Wallach Direct Testimony, page 9. And then the second correction is on page 17, line 1, and there needs to be a close quote at the end of the first three words there, rate base items. I was quoting ORS witness, and I neglected putting in the close for the quotation.
Mrs. Hager, with those changes, is your testimony correct?
Yes.
You have no other changes to it?
No.
Mr. Chairman, we ask that Mrs. Hager's rebuttal testimony be copied into the record as if read.
Ms. Hager's rebuttal testimony as amended will be entered into the record as though given orally from the stand.
And Mrs. Hager, do you have a summary of your direct testimony you'd like to give the Commission?
Yes.
So.
Mr. Chairman and members of the Commission, the purpose of my direct testimony is to describe and support the allocation of Duke Energy Carolina's electric operating revenues and expenses and original cost rate base assigned to the South Carolina retail jurisdiction and to each customer class according to the cost of service studies performed by the company. Using the principle of cost causation, revenues, expenses, and rate base costs are assigned to the specific jurisdictions and customer classes that caused such costs to be incurred. The cost of service study used as the basis for this case begins with the official accounting books and records of DE Carolinas for the 2017 test year, as discussed by witness Doss. The costs are grouped according to function, such as generation or transmission, then classified based on whether they are associated with demand, energy, or customers, and finally allocated or directly assigned to the proper jurisdiction and customer classes based on cost causation principles. Production and transmission demand-related costs were allocated based upon DE Carolina's coincident peak demand, which occurred in August of 2017. Distribution demand-related costs were allocated based on non-coincident peak. Customer-related costs, including customer-related components of the distribution system, were allocated based on the number of customers. This methodology allows the utility to assess how much of its distribution system is installed simply to ensure that electricity can be delivered to each customer if and when the customer chooses to use electricity. The theory behind the inclusion of a portion of the distribution system as customer-related is sound and consistent with cost causation, which is the foundation of cost of service studies. Once all costs and revenues are assigned, the study identified the return on investment the company has earned for each customer class during the test period. These returns can then be used as a guide in designing rates to provide the company an opportunity to recover its cost and earn its allowed rate of return. My testimony also provides an explanation of the allocation factors used in the excess deferred income tax rider. I conclude that the company's chosen methodologies to allocate cost in this proceeding are reasonable and appropriate.
Does that conclude your summary of your direct testimony?
It does.
Would you please now give the Commission a summary of your rebuttal testimony?
Yes, the purpose of my rebuttal testimony is to address intervener testimony related to Duke Energy Carolina's use of a minimum system study to allocate distribution system costs. Generally, interveners agree that costs are functionalized as customer cost are also appropriately allocated to the customer classification. These include cost of the service drop-in meter, meter reading, billing and collection, and customer information and services. Witness Dharma Wardina, Vote Solar's witness Justin Barnes, and South Carolina NAACP, South Carolina Coastal Conservation League, and Upstate Forever witness Jonathan Wallach raised issues with regard to the minimum system study, which identifies a portion of the distribution system as customer-related. The concept used in the study was to consider what distribution assets would be required if every customer had only some minimum level of usage, for example, a single light bulb. I also explain in my rebuttal testimony that the NARUC Electricity Cost Allocation Manual includes the minimum system methodology as one of the alternatives for allocating distribution costs. I explained that the company is proposing the use of the minimum system concept at this time because of its increasing concern with the subsidization allowed in the existing rate structure and the importance of improving the price signal sent to customers through its rates. I explained that the theory behind the minimum system study is sound and consistent with cost causation principles. I show that it is neither dubious nor implausible for the company to assume that customers who ask to be connected to the grid will want to use electricity. All customers expect that the lights will come on when they flip the light switch. In order for that to happen, the company had to install some minimum amount of distribution facilities in addition to the service drop-in meter. Without that minimum system, there is no flow of electricity. Each customer caused some portion of the distribution system to be built. I explained that it is the current rate structure that is sending erroneous price signals. I also rebut the specific criticisms regarding Duke Energy Carolina's development of the minimum system method. Finally, I defend the company's treatment of advanced metering infrastructure and uncollectible costs. In conclusion, I note that the ORS found that the cost of service methodology used by Duke Energy Carolinas to be reasonable. I continue to believe the methodology used by Duke Energy Carolinas in conducting its cost of service study for this case is appropriate and reasonable.
Mrs. Hager is available for cross-examination.
Thank you. Okay. Okay, I don't want anybody to get up, but I just want to sort of see what we got in front of us here for cross. Mr. Cully, you going to cross?
Probably no more than 3 minutes.
Okay. Ms. Ferguson? Ms. Thompson, are you going to? Okay. Ms. Lee? Mr. Elliott? Ms. Grunman? Okay. Okay. All right. So here's what we're going to break for lunch. We've got it, and sorry to get you up here and get all that going, Ms. Hager, but it's the way it works in life today. We've got a commission meeting that's going to happen at 2 o'clock. It'll be fairly brief. And we have a pre-scheduled transportation hearing that will commence right after that, which will also be fairly brief. So I would be prepared to come back in here by 2:30. And, you know, you don't have to be in here for any of that. You can. You're certainly welcome. But that's the schedule. And then we'll commence this hearing as close to 2:30 as possible when we get restarted, and we will end it when it's over. Thank you. We are adjourned. Y'all.
May I please see counsel briefly?